Let us now drill down on the local equities opportunities that we can look at. And to join us in this discussion, the panel discussion, let me introduce the fund managers that we invited for this afternoon. First, we have Philip Hagedorn, an industry colleague and a veteran fund manager. He's the Chief Investment Officer of ATR Asset Management Group, with now managing over 120 billion in assets under management. He has more than 28 years of experience in equities and asset management. We were talking about it earlier. We're about 30 years here in the market and we're still here. And yes, he still oversees the investment team of portfolio managers, analysts, and dealers of ATR Asset Management. Welcome, Philip.
Thank you, Marvin. Thank you.
Yep. We have next Mr. Miguel Agarao. We have another industry colleague who is currently the Vice President of PH Equity Management, where he manages the different funds under PH Equity. PH Equity has more than 18 billion in AUM and has the longest and one of the best performing equity funds in the country. And he's responsible.
Good afternoon, Marvin.
Yes. Hi. Thank you for joining us, Miguel.
Thanks for inviting me.
Sure. And the third panelist, not but the least, good friend, we have another veteran fund manager here, Mr. Wilfred Keng. He currently serves as director of First Metro Asset Management Inc., looking over its investments with over 14 billion in assets. He has over 30 years also in financial and banking experience. Previous to FAMI, he was the former Asia Regional Fund Manager of Pine Bridge and also former head of equities fund management in AIG Global Investments. Welcome, gentlemen. Hi, Wilfred. Hello.
Hi, Marvin.
Good. So let me start this panel by asking Philip. Having heard what Sue presented just earlier, I'd just like to get your views. She did some analysis on the global sector and the things that we can look at. And I would like to hear your views. Do you agree with her views? And if not, can you share your views as well on the global perspective, Philip?
Well, thanks, Marvin. And again, thank you for inviting today. Normally in a room, I'm the most optimistic person, normally. And I don't think I've used the word Goldilocks to define a part of what next year might be like. So I'm very happy. I mean, I'm encouraged by what Sue's outlook is pointing towards. I agree that we will continue to move forward, not backward, right, in the end of the day. But we're always going to have that volatility. I don't think, we're out of the woods just yet from a health crisis, as we all know. But we're learning a hell of a lot more about how to deal with it, both from a market standpoint and from a personal living standpoint, right? How to protect ourselves better, how to just get on with our lives, right? Get on with our lives. And I think that's where we're going to continue to go. I would expect that we learn every time we go through this variance, new way and new approach, and we'll continue to move forward. Our view, I think one area that Sue talked a lot about was inflation and that persistent, uncomfortable inflation. In the Philippines, it's been uncomfortable all year, right? Our average inflation rate this year has been 4.5%, well above where the globe is. So I think we're gonna our next 12 months will be elevated. We'll still be at close to 4% on the average, but I think it'll be averaging better than what we averaged this year. In other words, lower over the full year next year. Now, we're going to probably start still at a quite elevated level, but I would expect that we will settle to an average that's actually lower than our average this year, next year. Mm-hmm. That might be different in the global space, but in the Philippines, I think that's what we're looking for.
Good. So, talking about the Philippines, Philip, can you probably drill down now in the domestic market? We are now what, 7,100.
I have a chart there to show some asset class
What
performance.
do you do in our market now? What are they pricing? What are we pricing here? What are your scenarios? Can you just give us an idea of your view?
Why don't we just take a quick step back, because I think for multi-asset investing, this is like your map. This looks like a very confusing chart, but these are all the asset classes that we can actually invest in as Filipinos today. Our global multi-asset strategies, we look at 5 asset classes, right? Global equities, Philippine equities, global fixed income, Philippine fixed income, and alternatives. And the basic view for next year is overweight equities, underweight fixed income, overweight alts. So the underweight in fixed income is being made up by the investment in alternatives to make up that yield, that hunt for yield that everyone's looking for. But I want to focus on Philippine equities, because the last 5 years we've been the kulelat.
Where are we there, Philip? Where are we there?
We're the dark blue. That dark blue box is the Philippines. Starting in 2016, save for 2017, which is a decent year, 18, 19, 20, we are among the worst performing asset classes that we're covering in the world. And by the way, if you look at 2018, for example, look at the returns of all the asset classes. They were negative. There was not one single asset class that had a positive return in 2018. Even in the pandemic year of 2020, returns were better in 2018. So how will this shift? How will this change, right? I mean, Philippine equities, I think, is really an area that will shine in the next couple of years. We're starting at a very low base. We've taken all the cream you want off the top. And I think there's a solid story for Philippine equities, at least for the next 12 to 24 months, in my view. And, we can perform. As you see in the early years, post-crisis 2009, the Philippines was the best performing asset class 3 out of the 4 years after that crisis, right? So, will history repeat itself? I sure hope so. But I think there is an argument to be made for the Philippine equity space to really deliver alpha next year.
Good. So, like, what do you see in the Philippine equities, Philip? I mean, we have our focus is always bottom up fundamental earnings, and so if we start from the earnings story, we beginning of this year we said we'd see earnings around 30 to 35% earnings growth this year. The numbers coming out around 31% so far, and we also said that based on a fair value for PE multiple and that earnings number, that 7,500 would be a fair target. And we actually got there in January, right? Sold off and then recovered, and just the last 3 days, because of the new Omicron scare, we've sold off again. But I'm not too worried about this sell-off at this point. I think I look at it as a buying opportunity. I focus on how the earnings recovery will push through into next year, and what sectors will deliver those earnings. I think, as we know, this market, this is the 30 years, Marvin. This is the picture of Wilfred, you, and myself story of the right? Yeah, tell us the story.
The colors here are presidents, right? The big colors. So you have the gray as Cory Aquino, the red as FVR, then the green as ERAP, GMA in the gray, then the purple with Pinoy and Duterte in the final gray. Then there's those light blue boxes, which are global crises that we could not control. We didn't shoot ourselves in the foot. This is stuff that came to us and we had to deal with it. Clearly, during the ERAP crisis, you can see that we didn't recover right away post-pandemic. We had issues to deal with. I remember GMA had to pass VAT to save us at that point, if you recall. We had a budget deficit crisis, current account deficit crisis. We had no money. We had reserves of under, I think, $20 billion at that time. And remember, the economy was never over $100 billion in GDP until 2005. That's the first year that we crossed over $100 billion. In 2019, we hit $350 billion in GDP. By the way, we didn't drop below $350 billion last year, and this year we're not dropping below it either. So although our ranking is poor and we've taken a bit of a hit, lousy performer in ASEAN, look at the relative value, where we are, where we've come from, and where the base is. We have reserves of over $100 billion. We have investments like never before. We have actually live, hardcore infrastructure investments going on today. Right?
So Phil, let me cut you there because so what do you see the market? Where do you see the market? Do you have some kind of a forecast?
Yeah, well, we do. Our forecast is 8,600 for next year. 8,600 on the back of 45% earnings growth and a PE multiple around 19 times, which is still below our 5-year average. So to me, I think we're reverting back to kind of a mean one. Now, it's not going to happen overnight. We need a clear path from the corporates, but all financial investors are very familiar with technicals. My mentor here, Juan, is going to get mad at me because I didn't draw these lines exactly how I should draw them, but he will tell you, I'm sure, and maybe he can agree, there is a cross between the downtrend starting in 2018, that high of 9,000, and our low of the pandemic. And that cross will happen first, second quarter of next year. Now, you believe that we will end 3 years from now at 6,000, or are we going to see a new high 3 years from now? And I think clearly the way we're set up, the economy, the companies, the opportunity that we have with how things have evolved during this pandemic, which, by the way, to our surprise, discretionary spending even grew while transport was very low. There is a change in the way in behavior that is happening under our noses, and that's what makes us optimistic about the target. It's purely based on earnings and purely based on a PE multiple we see. But we have an election. We have hopefully a whole new plan, and we have a base that's very solid, right? Building off of. So my view is we're gonna work our way to 8,600. Don't ask me what day, but I think some point next year, that number of 85, 8,600, we will see.
I hope I'm with you there, Philip. I'm with you there. I hope you get that. But I like your bull case at 9,400. Very bullish on that front. Huh? Good.
Well, we've seen years like 2015 and 2017 where in one quarter, foreigners will have $1 billion in inflow. I'm not writing that off, that can't happen in the next 12 to 18 months. Maybe they need to get comfortable with the new government, but I think once that happens, and whatever happens, that inflow can come very quickly. Remember, it left. There's not many foreign investors left in the country anymore.
Hopefully. Thank you for that.
And 30 years shows that they always come back. So.
Okay, I'll get back to you, Philip. I'll get back to you. Let me go to Miguel. Miguel, do you agree? What is your view? 8,600. What is your house view, or what is your view?
Good afternoon, Marvin, and hi, Phil. Okay, Phil is always more bullish than me. So our target for next year is about 7.9. It can reach that 8.6, but we're just putting probabilities on certain events. So if you just put all that expected value together, we're looking at 7.9. Although we hazard that is subject to review because, as all of us know, the next 6 months are going to be a very exciting 6 months. So we just try to put all the uncertainty together and create an expected value outcome, and where we're looking at about 7.9 for next year.
Yeah. So you're talking about the next 6 months. I'm sure you're talking about elections.
Elections plus. A lot can happen there.
So I know that the next leader could be critical in how markets will react. How do you
Yes.
think these elections will impact our local market next year? What are the scenarios you're looking at here, Miguel?
Well, there are two ways to look at it before you actually invest on it. And since I'm not the best political analyst out there, one way to do it is you create a portfolio that is fairly, how do you say, politically agnostic, or you try to bet on what the political outcome will be. And since I'm not in the second camp, we try to make a more politically neutral portfolio, something that can have secular growth regardless of what the composition of the next government will be. But but much ado is being given on how to invest based on politics. So I just want to simplify that decision-making process. So the way I'll do it is I'll just show the previous election. So this is a good jump-off point from what Phil mentioned earlier, where he showed how the market moved across elections and different macro cycles. So I'll just zoom in more into what he actually showed. So this is 1992, and you'll see the first few charts will be the market rate at the 1,000 plus level. Okay, and okay, I'm not like as long as your era, guys, because I'm the younger one here. I'm not like kayo na, you've been here quite a while. But as you can see, from that time until now, regardless of all the crisis, the market is like 7,000 plus. This is 1,000 plus. So you look at your 1992, the market, we're about 6 months right now before election. So what I wanted to do is a +6, -6 for this chart. So at least you get a 12-month view. And you'll see that 6 months head into elections in 92, the market was actually up 10.7%. 6 months after, it was up yet another 18.8%, even despite the drop you saw towards the end. Now, if you look at 1998 elections, now that's a bit trickier, because in this one, you had the U.S. financial crisis. The Asian financial crisis happened at around the same time. So even though the market was up 19.3% heading into elections, it lost all that and more. As corporates went bankrupt, the peso depreciated sharply, and you had the same thing with their neighbors. So you'll see here, net, you probably lost about 3+%. Even if you bought 6 months prior to the elections. But as Phil said earlier, this is not our fault. It's something that was really thrown on our lap. Although arguably over borrowing for corporates in dollar terms was partly their fault. But again, this is a regional crisis. Now, if you look at 2000 and 2004. You'll see here that on both cases, the market kept going up. It made 10%. If you bought now, and until election day, you're up about 10%. 6 months after elections, you're up about 16+%. And note that this one is coming from a low. After the dot-com bubble, era, political crisis, etc. So this is the 03 to 07 bull run. So that worked to our advantage. Then you have 2010. This one was quite spectacular. You had a consolidation heading into the elections, but after that you had a massive 37% move. Now this one again is coming after a bear market, the U.S. financial crisis 07-08. You bottomed in March 09. So again, that uptrend worked to your advantage. Then you have 2016. Where the market really just moved sideways prior to the election, down 1%. And note that during this time, surveys were really going here and there into the front runner will be. That's something that was quite special about this 2016 cycle, where the front runner was only known around March or April. Then 6 months after elections, the market actually went up first a lot before it started pulling back, but was still up. So the key message I want to deliver to investors here is that, except for one instance, which was the Asian financial crisis, if you buy 6 months prior to elections, 1 year later, you will always be in the money. And the only exception here was really 1998. So regardless of what the outcome is, as long as it's definitive and orderly, you'll likely be in the green.
And Miguel, why is that? Why is that? I saw your charts, no? It's generally it's a change in government. Is that basic reason, or is there any fundamental reason behind that?
Well, I'll do the shorter answers first. Now, the first one is domestic consumption tends to pick up heading into elections, and that's that the market prices that in fairly early heading to elections. And then, of course, there's some degree of uncertainty sometimes, which is why you'll see in some cases the market is consolidating in a rectangle prior to elections. And after elections, when you have a definitive result, you have a honeymoon period, and then, the market starts to move up after. It's kind of like dating. Like the first few dates, you're like, not so sure, okay ba siya, ganyan. And then, once the person pops the question, you say yes, and then all the uncertainties removed, right? And then the next thing you look at is this something that's good for me long term? And then what investors will be looking at is the economic team. Okay, it's the economic team that will be appointed by whoever the next president is. So that's also very important, not just who wins, but how investor friendly the new economic team will be.
So basically,
Marvin, can I add something here on that election?
Phil, yes, hi.
Elections are good for markets, especially democratic elections that are fairly won, because the majority wins, and the majority believes that person is the best for them.
Mm-hmm.
That's it. When you look at these two elections, 16 and 2010, it was a clear majority. And of course, you saw a bit of a pullback. No market can continue to go the way it's going, right? But those had clear rallies because it was a clear majority. So I think elections are generally good because democratic elections tend to put the person most people want in charge. And that's what people want in the end of the day. And I think that's kind of what drives the psyche of this honeymoon period.
So confidence is back. But asking the question back to Miguel, if we're going to buy now prior to election, is there any sector that you would like to look at to outperform next year?
The boring answer, and with what everyone is saying, are the opening plays, okay? But I want to be a bit more specific there, because in essence, the entire Philippine market, or most of the listed stocks in the PSEi, are the opening plays. We are a cyclical domestic consumption index. We are not like the S&P 500 where 30% is big tech, etc., right? So by virtue of that reopening, the Philippines gets clobbered on COVID lockdowns, and theoretically, when you remove the lockdowns and things get back, the base effect and then the ensuing growth should propel the index higher. However, if you notice, not all the opening plays move the same way. And other than the opening place, I think what's important is you look at the business model of the company. You have to buy companies whose business models either adapted to this COVID environment, and we can assume COVID will be endemic in varying degrees of lethality over time, hopefully lower. And second, those companies whose business model is unimpaired by either COVID or the move to digitalization or other substitutes. So you need to go to reopening plays who are able to navigate the COVID environment, or those reopening plays whose business models were not undone. Corollary to that, you need to buy those whose balance sheets are not as stretched, because you can imagine if the national government borrowed so much, the LGU tax revenue evaporated. You can imagine how this looks like for corporates. So you want to buy banks, but you want to buy banks with high NPL cover. You want to buy banks who are more exposed to corporate and less so to consumer, because in the early move of the cycle, I imagine consumer will recover slower than the other corporate capex will. You want to buy property but you want to buy property whose office side is not as exposed to a particular sector, which had an exodus this year and last year. You want to do residential, which is capable of maintaining a certain level of launches that is clearly trending up instead of one that is fluctuating. You want to buy consumer, which is not going to get as shocked if inflation spikes, someone that is able to pass on prices or control their costs. So at the end of the day, it's not just picking the sectors, Marvin, you have to pick stocks here.
Mm-hmm. So you pointed out three sectors here: banks, property, consumer. But be specific, be selective, right? Be giving
very selective, yeah. So at PH Equity, with the way we approach this COVID environment, we did not pick sectors. We picked stocks.
Good. Right. Sige. Thank you for that. Let me now go to. I'll get back to you, Miguel. But let me go to Wilfred. I think Philip mentioned slightly earlier that foreign participation may come back, maybe, I don't know, but what do you think? Are we going to be still locally dominated, or can we anticipate some foreign participation come next year?
Okay, from a perspective of someone who have done regional management, right, over the last decade, there's a huge difference from the historical analysis that was presented earlier by Miguel Bayon and then Philip, right? And the thing that's different is why the foreign participation have fallen dramatically over the last 5 years, right? So the main reason for that is that the Philippines used to be percent of the regional index. And then, I was doing regional markets na since the early 2000s. So when you move down the line, it became bullish for the Philippines because the trends in cyclical was doing very well, the economy. So generally the market was doing very well until you hit that 2016 area. So what happened there? What happened there was that parang China started awakening. Why? What do I mean by that? China has been like the second biggest market in the world, but nobody was really looking at China because practically, China was shut down from the rest of the world, from the rest of the investors. The global investors shunned China. They were afraid of the leverage. So, and the regulatory environment was not up to global standards, right? So they were never part of the MSCI benchmarks. That all changed in 2020 or 2019, 2020. So when China started coming into the benchmarks, the Philippines was marginalized further, right? Of course, it didn't help that the Philippine scenario was on a cyclical downturn. The cyclical upturn happened to be in the former administration. So for this particular administration that's about to end, it's more of a cyclical downturn as well. So when you have that, plus the marginalized component of the Philippines in the benchmark, that would equal the foreign participation falling dramatically from where it is, right? And of course, what Sue mentioned earlier, the QE has also been tapering over the years, so that's also not helping Asia. ASEAN funds, which have been so hot around the 2010, suddenly also flustered. The ASEAN funds have sort of stagnated over the last 5 years as well. So when you look at all that perspective, it's like there is like a probability that you're on a low base. So ASEAN may actually start outperforming moving forward, because you're also looking at the fact that China is in another state of what they're trying to go global on their regulatory standards, and that will put a dent on their economy, right? So that might shift some funds towards ASEAN. So in a way, the foreign participation for the likes of our country, the Philippines, would actually go up a little bit because of that. whether or not it'll going to go to that huge level from before, that's still a big question mark. But I would say pragmatically, it should come back in a bit from where, only because what I feel is because China will take a while, maybe a couple of years, for the regulatory environment to settle. So that's how I see it from that end.
So, yeah, good. So
Marvin, can I ask Wilfred a question? Ask
sure.
Wilfred a question.
Yes. Sure.
Oh yeah, I mean, I'm just engaged here. But, Wilfred, as a manager, as a regional or Asian manager, you didn't mention that China is now 40% of the Asia ex Japan index, right? From zero. It's not like it came in and made a little dent. They took 40% of the index, right? Do you think people will be neutral China now, or will they generally be underweight because of the concerns? Because 40% is a huge allocation to put to an area that has just banned like Jack Ma, right? We'll never probably see another Jack Ma come out of China again. So I'm curious about, they were so, we're going to do this right. Now they became 40% of the index, and then they changed the rules. And I'm wondering how regional managers are going to react to that. I'm curious.
Well, obviously, like if you're, it depends again on the type of funds that are available, right? If you have hedge funds, they're more wild in the risk allocation, right? But I mean, if you have generally very stable type of funds, you won't stray too far from the benchmark, right? So in the sense like China, as I've said, China would have that problem because of the regulatory environment. So if you're saying that it's now at 40%, the most, I would say, if you want to be underweight, the most is probably going to go down from 40. Yung pinaka ano na, I mean, I guess if you're going max now, probably will go down to 30. Yeah. I mean, if you want to go down to 20, that will be more of like the hedge funds type. But even the hedge funds right now is very different from the hedge funds from before. Well, that's another story, but I'll just briefly say why. Because hedge funds before are more aggressive. They just go one way. But now, hedge funds tend to be more on the safe side, which means to say that they make taya on underweighting or shorting stocks. But at the same time, they also have to do the other way around. They have to be long on some positions so that mabalance siya, so that the risk profile of the hedge funds will also come down because admittedly there were also a lot of hedge funds that collapsed about 5 years ago because of that one-way thing that they all just shorted, and then suddenly ay kung short ka lahat, patay, and then all the funds crumble. So
that underweight reflection possibly in China could be allocated to ASEAN. Right? Philippines might actually.
That's what I'm saying. So that's why I'm saying that I'm
Marvin,
just positive.
Thank you for that, Phil. But we're really interested to find out. See, we're trying to understand it. Because of the China, Wilfred, we want to understand that the foreigners have been zero. I mean, really very, very low in our market now, and it's really dominated by the local market and local investors. We want to see if confidence comes back, or hopefully confidence comes back with the new election, new administration. Is there a case for foreigners to come back, or is it because China is so large, hindi na talaga babalikin?
Okay. I look at it from like 5-10 years from now. Kasi I feel, I don't know of course what MSCI would do, but I feel that they're going to change the benchmarks because of the super dominance of China in the benchmark. It's too tilted. So eventually China would probably have to go to develop, maybe along with South Korea. So if that happens, then the Philippines will obviously still remain in the emerging market benchmark. Then tataas na naman yun weighting ng Philippines. So, but of course, as Philip mentioned, like if he's bullish on the 8.6 target, he doesn't know when. I'm going to also put in that I think that's going to happen, but I don't know when that's going to happen. I don't think it's going to be immediate, but I would think that maybe in the next 2 to 3 years that's gonna happen. So there is that positive case for the Philippines if you're just talking in that context. Ganon.
Whether foreigners come in or not, di ba? Whether foreigners
Yeah,
come in or not.
I mean it just on a technical viewpoint na, because I feel that eventually in the emerging market benchmark, markets like China and South Korea would probably be taken out. So if they're taken out and they get moved to the DM Asian market benchmark, then countries like the Philippines will have a bigger weighting again.
Yeah,
Right.
yeah, but it's very hard to anticipate that. Though. But you know, looking at, for example, it doesn't really happen. I mean, it stays the same. We're now more local or more retail, more domestic investors. What kind of allocation would you have for at least for the coming year, Wilfred? If you're going to,
I'm actually more positive on the Philippine equity market in terms of the diversification thing for this year. Why am I saying that? Because I think this year is the first year that I've seen a lot of local IPOs coming out in droves compared to the other few years, right? So, and most of the ones that came out this year are actually of a sector that are very different from what we're used to, right? As Miguel mentioned, it like Philippines, always cyclical, always whatever reopening. But look at the ones that came out this year. You have Converge, right, which was a telco stock. So telco, I wouldn't say it's reopening, right? Telco is more defensive, work from home type of sector, which actually has worked wonders for that sector. That sector has outperformed dramatically this year, right? Now, if you go to another sector that really boomed for the first time because it first came out this year would be the REITs. How many REITs came out this year from zero, right? You started with Ayala Land, then you have Mega World, Philinvest, Robinson, and there's still going to be a few more coming up next year. You're still gonna have your SMs and all that stuff. So that's potentially going to be a big sector to invest. So you have more the diversification element, and that's what nice for the fund managers for the Philippine market this time around is that they can diversify more. They can, into their funds. So there's a protection risk. Like Sue of Manulife, she mentioned earlier that she feels that the first half is going to be very challenging. So if you're gonna be on reopening plays in the first half of the year and then all these challenges come up, you're probably going to underperform big time. So the best way is to diversify and move into more defensive choices. But unlike before, where your defensive choices are so few, now it gets to have a bigger allocation for you on that other side. So that's nice for the Filipino fund managers as well, right? So it's a good thing.
yeah. So Wilfred, we're seeing kasi a lot of these offerings. So the IPOs, you have the Mondenises, the Ascents, diba? Para bang they're getting more choices. You're saying,
Exactly.
you're saying that our market for so long, panahon natin, that's always the same names.
Correct.
Now, we're getting a lot of these new flavors or new,
Right.
and that you see is the one that's driving the market now.
Yes, because if you have seen what's been happening in the last few months, all these new names suddenly they get added to the benchmark. Not just the local PSEi benchmark, but even the FTSE or the MSCI, right? I mean, these new names have been quickly added already. So that also means that the length of the breadth of the market is very thin. So that's why you need all these new names to come out. So, I'm just more than happy that this year that came into fruition. With this REITs and with the likes of Monde and Converge and Ascent, which are like generally respectable big names, right? I mean, to be added to the benchmark to begin with. So
Good.
So hopefully next year that can keep up.
Sige.